Melbourne house prices are moving backwards. Melbourne is the ugly duckling capital of the property investing scene. It ranks last on just about every single metric. It has done the poorest since COVID hit our shores. In this video, I'm going to go into a deep dive into the Melbourne housing market and unpack whether this story will continue, what is happening on the ground right now, and whether it represents a great opportunity for property investors today. Specifically, I'm going to unravel what opportunities exist for property investors and where you should look. Hi, I'm Ridham Syed, founder of Confidence Finance, 6 times top 100 mortgage broker, and I work with thousands of property investors, including many Melbourneites, in helping them build, grow, and scale their property portfolios. So let's go. Here you have Melbourne price data. What you can say unequivocally at the moment is Melbourne property prices are moving backwards. They're not moving backwards at a ridiculous rate, but we are definitely in a Melbourne downturn at the moment. Price data, factual price data, says prices are getting cheaper in Melbourne instead of rising. And this is after a long period of barely any rises at all. You see this in asking prices from SQM Research too, down nearly 2% for the quarter. Melbourne clearance rates, what happens at auctions every weekend, are also fairly weak, sitting around that 60% mark, fairly stable, but stable at a very low rate, which suggests that there's not enough demand to meet the supply out there at the moment. And this chart shows the number of listings that are out there at the moment in Melbourne. In Melbourne, Melbourneites are selling their properties. A lot of Melbourneites are selling their properties, much more than the buyers out there. This is pushing up days on market too. The time it takes to sell in Melbourne is shooting up a lot. The amount of discounting that Melbourne sellers need to go and do is increasing too. So these are all underlying demand factors. It is very, very weak. And underlying supply factors right now suggest listing levels are very, very high. This combination could be for a number of reasons. Perhaps it's the taxation situation that exists at the moment with the land tax for property investors and a number of property investors that are sitting there being like, this is all too hard. I've been scapegoated for too long in this town, in this city, in this state. It's time for me to pack up my bags and put my money somewhere else. Maybe I should go invest in Perth. That is not an uncommon story we've heard in recent years. But where is this price change happening? In Melbourne specifically, just like the rest of the country, the more premium areas are doing worse than the cheaper areas. The more affordable segments of Melbourne, think Melbourne apartments, think houses in cheaper areas, they're holding up okay. They're not falling in value. They're essentially just keeping their value. Meanwhile, the premium pockets of Melbourne, they are falling at value at pace too, -2%, 1.7%. That's pretty chunky in terms of the fall in house price in more expensive areas of Melbourne. On rents, Melbourne rents are bucking the trend that's happening all across Australia at the moment. The pace of rental growth is coming down, but it is still rising. So you have rents still continuing to rise, roughly by a percentage point in the last quarter, and Melbourne housing values continuing to fall. This pushes up Melbourne rental yields. Melbourne rental yields are going up at around 3.5% to 4% at the moment in that bandwidth, and likely going to settle in that range. So rents going up, albeit at a slower trajectory, and prices coming down, this starts sowing the seeds of an exciting little narrative where rents could trigger the next wave of property investment. We'll get more into that soon. On rents, the vacancy rate is starting to push up as the population growth rates in Australia start coming down. Vacancy rates are around 1.6%. Albeit still very, very low. Any vacancy rate below 2-3% suggests a very tight rental market and suggests really strong rental demand. And even though the trend is up, it's coming from such a low base that the rental market in Melbourne still remains fairly healthy. So what's going to happen to change this narrative, this dire narrative from Melbourne where prices are going down, rents are kind of flatlining, rising a little bit, but trending downwards, vacancy rates going up. All of the trend directions for Melbourne are not that positive at the moment, but this is just right now, which could represent a great buying window where you have no competition. But what's going to change this in the years ahead, and is there room for improvement? This all comes to looking at the economic activity and the change in economic activity that could be occurring in Melbourne over time. So looking at the CommSec State of State reports, you have the current Melbourne picture a little bit below the Australian economic growth rate, much like Sydney, very interest rate sensitive, a household sector that is struggling with the weight of high interest rates and cash flows being taken away from their household budgets. They're struggling at the moment, much like Sydney-siders, and that's not uncommon. Sydney and Melbourneites have similar day-to-day stories with their economy going on right now. Retail spending really, really weak as well. They're not spending out there. You'd expect that when economic growth is low. Equipment investment is particularly strong in Melbourne, at least in this quarter. That could be a data anomaly, but businesses seem to be investing there. There could be a couple major projects there, so a positive sign there. Employment growth, a little bit weaker than the rest of Australia, but not doing too badly. So broadly, their economy is very much like Australia's, not doing much worse, just a little bit worse, and it's the household sector struggling. Business sector and business investment, pretty strong. That's a little bit different to Sydney, but overall, these metrics are a little bit better than Sydney overall. And what you're seeing here is the trough. The Melbourne economy is at its low point. It's going to get better because interest rates are at their peak and interest rate cuts are coming at some point over the next year or two. We're already seeing that with banks reducing their fixed rates, and that is going to promote economic growth in Melbourne. You also have the tax cuts and you have fiscal stimulus kicking in, and these things will help Melbourneites spend more money, help the economy grow, help the job market improve, and then help the housing market as a result. Here's a quick little deep dive into their employment market. Employment growth roughly at the national average, unemployment rising up by about 30% in terms of the number of people unemployed this year versus the Australian average of around 17%. So that's rising a lot. Unemployment rate going from 3.7% to 4.6%. That number is a little bit concerning. It is above the RBA's sort of target, 4.5%, 4.6%. And we're only in July data here, so it's going to get worse. So that is something to look at, and that's why Melbourne house prices are moving backwards. Now, when you look at the employment data, it makes a lot of sense why it's really struggling. Participation rates and youth unemployment in double digits in Melbourne. It's just got there. So the employment story in Melbourne, not particularly good, fairly ugly, probably one of the worst in the state, if not the worst state in Australia. And that's why it's laggarding behind. In terms of the future indicators, let's look at the number of job advertisements in Melbourne, one of the first lead indicators. You've got a 32% change year on year in job ads. Broadly, the Melbourne employment story is ugly. The Melbourne economy story is ugly. These combinations is why house prices are moving backwards in one of our most populous locations, if not the most populous location in Australia. The biggest city is moving backwards, even though it is an economic engine room of Australia and is an economic powerhouse. It's moving backwards because the job market is moving backwards. They are correlated. When people don't get jobs, when people are worried about their jobs, and when businesses are struggling because economic activity is lower, they're not going to go and put ads up to go and hire people, and that's feeding into the data, and house prices are simply consequence of the economic activity going on at the moment. The one big plus point for property investors and for Melbourneites who have homes in Melbourne is the lack of supply coming in Melbourne. Now, Melbourne's typically done better than Sydney and other locations in terms of housing supply. But right now, they've got dwelling commencements and dwelling approvals fairly weak and trending down. So if the number of commencements of dwellings occurring in Melbourne is trending down, it's going to create additional housing supply pressures in the year ahead and begin sowing the seeds for the next boom if housing supply continues to trend down. And we talked about a number of reasons here in this video about New South Wales housing crisis and why people aren't building. You can put in the same story into Melbourne and have the same solutions into Melbourne because they have the same problems. They have slightly better planning controls and planning arrangements there that allow for more density, but they do have a feasibility problem and apartment prices and apartment costs are a little bit out of kilter, and that's why people are not building homes, which is a plus factor and one of the things to look out for. So summarizing, it does present a bit of a dire picture for Melbourne at the moment, but it explains why house prices are moving backward. But where is the silver lining? Where are the opportunities? Why should I invest in Melbourne? Can you make a narrative for Melbourne and the pro side of Melbourne? I certainly can. There is many things going for Melbourne that really, when you put a spotlight on, makes a lot of sense, despite all the things that we talked about. These are things at this point in time. But property investors, you want to look for change. You want to think about what's going to change the direction of Melbourne. If it improves, perhaps buying now, when no one is looking, when prices are moving backwards, when days on market are higher, when my negotiating power is at an all-time high. Perhaps buying now is the right time if there is change coming. Now, Melbourne is going to be a huge beneficiary of potential interest rate changes. In this video, we went through CBA's view of the economy and walked through step by step why they think 5 rate cuts are coming. And they were not even bold enough to talk about 2026, where they probably expect another 4 or 5 rate cuts to kick in and change the interest rate environment altogether. Melbourneites will benefit from that more than any other state other than Sydney. And that could trigger the economic activity that creates the demand for jobs and for property investors to go and look at. At the exact same time, you have some foundational things that you look for. You have a limited amount of supply. Dwelling approvals and dwelling commencements are very, very low at the moment, which means we're not going to build enough homes for the next few years. If these two things happen at the same time, you're setting the seeds for price growth. And this is the main reason, the underlying reason, the relative affordability of Melbourne. Melbourne's doing so bad right now that its dwelling prices are cheaper than Brisbane and even Perth now and falling behind the rest of Australia. This is good news for you if you're looking into Melbourne right now. It means that it's affordable, and it means that other property investors who often now look at data metrics, and one of the key data metrics that they look at is a lack of price growth. They want to buy bottom of the cycle properties. When the trend starts going up, Melbourne is on their agenda. Every single data-driven property investor has Melbourne looking at it, being like, when can I buy in Melbourne? When is Melbourne going to be okay? I want to buy in Melbourne. Look at Melbourne. You have thousands of people frothing, waiting on the sidelines. I want to buy in Melbourne. They're looking at it because Melbourne has only increased by 11%, while Perth, Adelaide, and Brisbane are up 60%. Melbourne is starting to look like green lights. Yields are going up, prices are down, rents are up, prices have not risen for a long period of time, and as soon as that economic activity kicks in on the back of rate cuts, Melbourneites, you're going to see a property boom based on data-driven investors, a herd full of people who just look at data, who look at information, who look at very, very basic, predictable economic principles, and then they go and flock. And when they come fast. They come hard. There's thousands of them all looking at your properties. You could pre-position yourself, take a little bit of a punt. Will they come to Melbourne? And when will they come to Melbourne? If you can answer those two questions and you get your timing right, you could be jumping into a property investing city that is about to do very, very well. It won't be in 2024. It's unlikely to be in 2025. But from 2026 onwards, when these rate cuts start filtering through and the herd comes in, could be a golden opportunity for property investors. And today could be the buying window to set yourself up for your future. If you enjoyed this video, hit that subscribe button and that bell notification, and I'll do this same analysis for Perth, for Adelaide, for Brisbane, and for every other capital, and I'll do it regularly so you get live updates on the Melbourne property market and get your timing even better by looking at the data and getting the analysis you need to make better property investing decisions.